Hello everyone, we are now starting with the new topic capital structure. So the whole topic is based on the 2 points. One is about the theories of the capital structure, and the second point is the decision of the capital structure. First of all, let us understand what is the meaning of capital structure. If you want to start a business, okay, you need money, and we call money as capital. Now, what are the sources of money for you? What are the sources of money for you? Either it can be through equity, or either it can be through debt. No other possible option of getting the money from the market. Either you invest your own money, or put up the money of the shareholders, or borrow money from the market known as debt. Clear? Now, with respect to equity and debt, we have studied a lot when we are doing our portion of equity, but we all know that they both come at the cost. In the equity, it is considered to be as very costly. Where debt is cheaper than equity. But in the debt, there is a burden of the payment of interest. But in case of dividend, okay, there is no burden of paying regular dividend. Are you getting my point? In the debt there is a burden, in the equity there is no burden. Apart from this, you have to take the decision based on the growth you are expecting, based on the growth and return you are expecting. Clear? Suppose you are paying 15% interest to the debt holders and your return is expected to 35%. So if you will take maximum amount in the form of debt, then the profitability will be 20%. But if you will take maximum amount of equity, then this 35% will be divided among all the equity shareholders. Are you getting my point? So because of which we have to take the decision that what part of the money we will take in the form of debt and what part of the money we will take in the form of equity. Clear? So this chapter is about these two things. Clear? Now we need to start with the possible theories of the capital structure. So in the theory portion, we have to cover these three major heading. One is that how the capital structure will change for an organization. Proposition. In this we have three different things we have to study, and the last one which we have to study is the static trade-off theory. So let us begin with how capital structure will change. Now, whenever you will decide your capital structure, the most important point which come to your mind is weighted average cost of capital. Weighted average cost of capital means, if you are borrowing equity, if you are taking the money in the form of equity, as well as you are taking the money in the form of debt. Suppose debt is of 12% and the cost of equity is say 18%. Clear? So on the basis of this, you have to decide a point where the average cost of capital will be minimum. This is something which we have to decide with. This is something which we have to come up with, that we want the minimum amount of cost of capital, the money which we are taking into the business, we want the cost of that money to be as low as possible. Because if the cost will be low, then the profitability will be high, and then the growth of the organization will be higher. So this is the one most important point, that we want to minimize our weighted average cost of capital. Next important point is that whenever we want to calculate the debt equity ratio, for the purpose of capital structure, remember, for the purpose of capital structure, not in any other case. Only when you want to calculate the debt equity ratio in the context of capital structure, you will take the market value of both debt and equity. You will take the market value of debt and equity, because you want to know the present value, because you want to know the present situation of your debt equity ratio. You don't want to take the historical value or the accounting value. Means suppose you have taken the debt 15 years before, okay, you cannot take that cost. Take the present market value of the debt and accordingly calculate the debt equity ratio, because it will give you the idea about the leverage in the present scenario. Are you getting my point? Might be 10 years before your value of equity was much higher, but now it is not. If your equity value is lower, then that means what? You are sitting on a very high leverage at present. So remember this second important point, that debt equity ratio, for the purpose of debt equity ratio, we have to take the market value of the debt and equity. Now point number 3, how to decide how much debt we need to take. How to decide how much debt we need to take. So write down the answer. It is dependent upon the characteristics of the company. This is dependent upon the characteristics of the company. Write down the 5 characteristics. Point number 1, growth and stability of revenue. Clear? Means what? If the growth prospect is very high, my revenue is stable, that means what? That means I can continue with the debt, because I have the ability to pay off the interest, I have the ability to pay off the principal. Clear? Write down second point, growth and predictability of cash flow. Again, if my cash flow is growing, means what? I have enough cash in my hand to pay off the interest rate, to pay off the debt account. Clear? So growth and predictability of the cash flow, if it is really good, then we can move ahead. Next, very important point, amount of business risk. Means how much business risk do you have. If you have huge amount of business risk, okay, whether it is from operational risk, demand risk, okay, or because of the market risk, any kind of credit risk, clear, then what will happen? There is a huge shock on the earnings, there is a huge shock on the cash flows. Clear? So this will reduce the chances of the debt. Because higher the risk, higher the cost of the debt, and if the cost of debt will increase, it will create huge amount of loss to the organization. Write down point number 4, amount and liquidity of company asset. First of all, what is the amount of assets do you have, and are they liquid or not? Why? Because if I have the assets in my company, then what I can do, I can pledge it, okay, or I can put it on collateral and make the debt more attractive, because when you will put collateral and you will take the debt, it will come at a very low cost. Clear? And when assets are more liquid, you can easily either convert them to cash, or you can put them on collateral and you can ask for more money from the market. Clear? Next important point, what is the cost at which you are getting the debt, and whether it is available for you or not. What is the cost at which the debt is available to you, and whether the debt is available to you or not. Clear? Because there are some good companies which can take the debt at a very lower cost, but there are some companies who seems to be very risky. The cost of debt for them is going to be very higher. Clear? Are you getting my point? Now write down next point number 4, the effect of different stages of the company life cycle, on debt equity ratio means when the company is in the startup stage, growth stage, and at the mature stage. Clear? So what are its impact on the debt equity ratio? So we are going to study about the three stages. Number one, startup stage. Then we are at the growth stage, and then we receive the matured one. So what is the difference in the debt equity ratio? Now when I'm saying about a startup, okay, so in the startup the sales will start increasing, okay, sales are just beginning, then the operating earnings are very low, cash flow is very low, even it can be negative, business risk seems to be very high because the stability is not there yet, the debt is considered to be quite risky. So if the debt is risky, it will require high interest rate. So the cost of my capital is going to be very high. Apart from that, I don't have enough assets, whether it's fixed assets or account receivable. So if assets are not available, then I cannot put them on collateral. So this is the reason the company at the startup stage, they are mostly focused on equity. Clear? Because the debt is going to be very costly. Clear? Now what will happen in the growth stage? Basically revenue and cash flow, they are rising, okay, growth prospect we are getting. Now business risk got reduced. I'm not saying it's not available, it got reduced. Clear? So if business risk will reduce, then debt financing cost will also reduce, debt financing cost will also reduce, and investors are ready to give their money to you because they see the growth in your business. Clear? Now you have some amount of fixed assets and account receivable, so you can even put them in the form of collateral. Are you getting my point? So in this scenario, I can finance my capital structure by 20% of the debt and 80% still with the equity because it's rising, business risk reduced, you have some amount of fixed assets and account receivable, okay, that's why people will give only 20% in the form of debt. Now when you are at the matured stage, means you have taken care of every possible difficulties and then you will reach to this particular stage. What will happen? You are into the peak of revenue. Now revenue growth will slow down, okay, business risk is lower because you have reached at that stage where you gain the market share, you have the good amount of cash flows, okay. Now in this scenario, when you have the good amount of cash flows, lenders are ready to lend you the money because they know that now you have enough cash in your hand to pay off the interest and the principal amount at the time. Clear? Now you can issue secured debt as well as unsecured debt. For the secured debt, you have to put up the collateral. For the unsecured debt, you do not have to put up the collateral. Clear? Are you getting my point? So the equity will now converted into the debt. Now what will happen? You will grow more and more and more and more. So what will happen? Your value of equity will rise and the need and the demand for the debt will reduce. Okay, your debt equity ratio will also improve. Clear? Also, you are going to reduce the cost of capital structure. Also, you will start paying good amount of cash dividend to the equity holders. So this is how debt equity ratio will vary. Here equity is the highest, here you will get some amount of debt, here you will get good amount of debt, but gradually you will reduce the debt from your organization because now you want to be more stable, okay, you want to reduce the cost and you want to pay more and more to the equity shareholders. Clear? So this is the end of the first point, that how capital structure will change. Clear? What is capital structure? We want it to be minimum. Clear? Second point, if we are calculating the debt equity ratio, we will take the market value. Third, how we decide how much debt we need to take based on those 5 factors, and then different stages of the life cycle of the organization will decide the debt equity ratio. Okay, now let us start with proposition. Basically it is done by two person. There was a theory on capital structure by Modigliani and Miller. Okay, they are the two person who came up with the theory on the capital structure. So it was 1 and 2. Okay, these we are going to study without taxes, means with the assumption that there are no taxes, but we know that it is not possible, but still we will study. Now what they have actually proposed, let us try to understand that. They are saying that whatever capital structure you have, the value of the firm, value of the firm is unaffected, this is something which is proposed by them. Clear? And this is the most important statement. What is the value, what is the meaning of the value of the firm? Means the asset of the organization, asset of the company, it is going to remain the same. Asset of the company is going to remain the same. Means if I am going to give you an example, suppose you have the asset of $100. Clear? Now the whole asset of $100 can be financed by $100 equity, means your debt is 0. Still the value of the asset is 100. What's the another possible option? Your asset of $100 can be financed by equity 70, debt 30, but still the value of the asset remains the same. Or it can be done like this: asset is of 100, equity is of 10, debt is all of 90, still the value of the firm is same, that is $100. Clear? So this is actually the result of MM1. This is the result of MM1. Clear? Now there are some of the assumptions. Okay, there are some of the assumptions. So what are those 5 assumptions which helped us to reach that conclusion that the value of the firm is going to be unaffected from whatever the capital structure is? Clear? So the number 1 is the markets are perfectly competitive. Clear? Then write down second point. Investors have homogeneous expectations. Then the borrowing and lending, they both are at RF. There is no agency cost. Meaning that there is no conflict of interest between the managers and the shareholders. Clear? The fifth point is investment decisions are unaffected by financing decisions. Write down: investment decisions are unaffected by financing decision. Now what is the investment decision? What is the meaning of investment decision? Means you want to purchase plant and machinery. Okay, what is financing decision? Financing decision means you are going to borrow the money either from equity or from debt, or you have to repurchase the shares, or you have to announce the dividend. So they both are independent of each other. Clear? Markets are perfectly competitive means there is no transaction cost, no taxes, no bankruptcy cost. Every investors have the same expectation with respect to the cash flow generated by the firm, the return generated by the firm. Borrowing and lending both are possible at RF. Agency cost means there is no conflict between the managers and the shareholders. Investment decision and financing decision, they both are independent. Now there was a concept explained, that is EBIT, earning before interest and tax. Suppose there is a company whose EBIT is $700. Okay, means after all the possible expenses except the interest and taxation cost, they made $700. Clear? Now if I am saying that my company is fully financed by equity shareholders, then the cost of interest is going to be 0, and the whole 700 will belong to the equity shareholders. Are you getting my point? Or there is 50% equity and 50% debt. Clear? So what will happen in this scenario? In this scenario, the whole $700 still belongs to the debt holders and equity holders. Still belong to the debt holders and equity holders. How come? Try to assume that there is one person, he is only holding the debt 50% and he is only holding the equity 50%. So what will happen? Suppose the interest is $200. So he will get $200 in the form of interest. Remaining $500 will belong to the equity shareholder, and he is the 50% shareholder. He is the shareholder of the company. So can I say that the $700 is the value to the equity shareholder as well as to the debt holders? Clear? So means, can I say the operating earnings are unaffected by the financial decision? Can I say EBIT? Write down EBIT or operating earnings. EBIT is also known as operating earning. It is unaffected whether you finance your company with equity or debt, because this is going to remain the same in all respect. Clear? This is the meaning of proposition 1. Clear? Now let us come to proposition 2. Now proposition 2 is taking up the concept, two different concepts. One is the cost of equity. As I said earlier, equity is much costlier as compared to the debt, and leverage. That is the point of debt equity ratio. Clear? So let us start with the proposition 2. Now what is the intention and what was the conclusion which is coming from proposition 2? They are saying that the first point, let us do it from the point of view of the understanding perspective, that if this is an organization which is fully financed by equity, then think it from the equity shares holders point of view, that whatever earnings will be there, whatever earnings in the organization will be received by the equity shareholders. Now suppose that it is financed by 50% equity and 50% debt. Clear? Then what will happen in this scenario? So in this scenario, half of the cash flow, means the first priority, okay, if I'll talk about the priority of the cash flow, it is taken up by the debt holders. So can I say the equity shareholder are at risk? And when they are at risk, the cost of equity will increase. Now suppose that there is only 20% equity and remaining 80% is debt. So what will happen in this scenario? Sir, they got the maximum priority and lots of burden on the organization to pay off the interest. Clear? So try to understand from EBIT. Okay, you have to first of all deduct the taxes. Clear? Sorry, you have to deduct the interest first. I have to deduct the interest first, which is paid to the debt holders. This is the priority. Clear? Now profit before tax. You have to deduct the tax. Now profit after tax. This will be taken up by the equity shareholders. Are you getting? So there is a very lesser amount left for the equity shareholders. So in this scenario, the cost of debt will be lower. Suppose, why I am taking such a huge amount of debt? Why? Because of the cost of debt is lower. Clear? But when I am increasing the debt, my risk to the equity shareholder increases and my cost of equity will increase. So proposition 2 is saying that when you are calculating the weighted average cost of capital, which comes from the cost of equity plus the cost of debt, it is going to remain the same. First of all, let us understand, if there is only cost of equity, there is no scene of cost of debt. But when the debt will enter into the scene, why debt will enter into the scene? Because it is available at a lower cost. Clear? So you will try to increase more and more debt, and you will decrease the portion of the equity. Clear? So what will happen? The cost of the equity will increase. Cost of equity will start increasing, and my weighted average cost of capital will remain the same. Clear? Now write down one statement. MM2 tell us that as company increases the proportion of debt financing the risk of cash flows to equity shareholder increases. Definitely the risk will increase for equity shareholders. Are you getting my point? The risk of the cash flows to the equity shareholder increases, which increases the cost of equity. The conclusion of MM2 is that the decrease in the financing cost, the decrease in the financing cost from using a large proportion of low cost debt from using the large proportion of low cost debt. See why I am increasing the proportion of debt? Because the debt is available at a very cheaper rates, is just offset by the increase in the cost of equity. Clear? Resulting in no change in the firm's weighted average cost of capital. So means they are saying that whatever will be your capital structure, two things are going to remain the same. One is the value of the firm, which is set by MM1. Next, whatever will be your capital structure, your weighted average cost is going to remain the same, set by MM2. Clear? Now we have a relationship between the debt and the cost of equity. That is, the cost of equity means, as I am saying na, if I am increasing the proportion of debt, my cost of equity is increasing. Let us see the relationship. Cost of equity is equals to cost of equity when the debt is zero. Cost of equity is equals to the cost of equity when the debt is zero plus debt by equity ratio. Then the cost of equity when there is no debt minus the rate of debt. Now suppose when there was no debt, the cost of equity when there was no debt is suppose 7%. Clear? So RE is equals to R0, that is 7%. The rest of the values will become 0. Why? Because the debt equity ratio will become 0 when there is no debt. Clear? But now suppose I have taken the debt. Clear? So what are the details of debt? First of all, I have taken 20% debt. First of all, I have taken 20% debt, and cost of debt available is say 6%. Cost of debt available is say 6%. Now let us see what is the new cost of equity. Clear? The new cost of equity is going to be 7 plus debt equity ratio, that is 0.2 divided by 0.8 bracket open. The cost of equity earlier 7%, cost of debt 6. Clear? Let us calculate this fast. What is the value? Do it fast. So the cost of equity is now 7.25%. So can you see, when there was no debt, the cost of equity is 7%, and when we have introduced 20% of the debt, the cost of equity increased to 7.25%. Now suppose you increase the debt more. Why? Suppose the debt is say 60%. Why? Because the cost of debt is only 4%. Clear? Now let us see the cost of equity. Cost of equity is 7 plus 0.06 divided by 0.04 bracket open, 7 minus 4. Clear? Let us solve this. Do it fast. It is going to be 11.50%. So can you see, the cost of equity is increasing because you are increasing the debt in the organization. Clear? So